Hi, this is Dr. Tom Gerard, and I'm going to give you some very brief and a few important things that you need to know about the statement of cash flows. You know, understanding the statement of cash flow is a complicated thing, and right now I just want to go over a few things that you need to know if you're taking an accounting course, and you might need to be exposed to the statement of cash flows. Well, what is the statement of cash flow? Well, it's one of the four financial statements that we talk about in accounting or in business. You have your income statement, you have your balance sheet, and you have your statement of owner's equity or shareholders' equity if it's a corporation, and then you have the statement of cash flows. So the cash flow is different from the income statement in the fact that it talks about, it actually shares the information about real cash, real money, where the income statement is your profit and loss. And at the end of the year, you might have a profit, but you may not have cash in the bank because you use accrual accounting according to generally accepted accounting principles. And in accrual accounting, you have accounts receivable that maybe you've bought some, you've provided goods or services for your customers and they haven't paid you yet. You're going to bill them and they're going to pay you maybe next month. On the other hand, you may have things that you've purchased, supplies or inventory or equipment that you've purchased on credit, and you're going to receive them, you're going to pay that money actually next month as well. There's other things that go into this calculation of cash transactions that may or may not be cash. I mean, when we do a depreciation expense on a long-term asset, that is actually not cash. It's not like you're writing a check to somebody to pay depreciation. It's just an accounting transaction. And so therefore, it's an expense on your income statement and it lowers your net profit, but there's no cash actually going out. So really, the whole idea behind the statement of cash flow is so that you can take the income statement and change it into a cash format that's reported on the balance sheet at the end of the accounting period, and that way you can really see where you're at on a cash basis. Most accounting software systems nowadays that companies use, including small businesses, have the capability of tracking cash and your income statement and your balance sheet at any given moment. And so as a business owner, you want to know what your cash position is at all times. But now let's talk about some of the things you need to know basically just for your accounting course. And you're taking the accounting course and you've got to know something about this statement of cash flow for accounting. So first of all, just like we said, the statement of cash flow talks about cash going in the company and cash going out of the company for a specific period in time. So how do you generate cash is a few questions, right? So you generate cash from operations, which basically operations, that's what you're in business to be doing. You're out working and providing a service, or maybe you're selling product and you're receiving cash. That's cash from operations. Now, you may use cash to maintain or expand your operating capacity. In other words, you may be buying equipment to expand your capacity. You may have to put cash out to repair equipment and that kinds of things. Maybe you're buying a new building and moving into another area. So you have to have cash to expand your operating capacity. You also may need to meet your financial obligations. Financial obligations means I've borrowed money and I need to pay the bank back. Now, of course, financial obligations could be a lot of things. Like I said, if you have vendors that you've received products from, or inventory or supplies, and you haven't paid them, that's a financial obligation. You have employees that when they provide a service or they work for you, you need to pay them. Everybody expects to get a paycheck, and they expect their paycheck to be cash. So let's take a scenario that you had employees that went out and they worked for you, and maybe they were doing a job, if you're a contractor or something, and you had employees that went out and provided work for you, but your customer that you were doing the construction work for, they didn't pay you. They're going to pay you at the end of the maybe it's 6 months, a year or more when the job is complete. But your employees, they want to be paid on payday, right? So in this case, you need cash to pay them, even though you haven't received the money from your customer. The last one, of course, is paying dividends. So if you're a corporation and you're paying out money to the investors who have bought stock in the company and their shareholders, you have to pay. You pay dividends. If you declare and pay a dividend, that requires cash. Okay, so the statement of cash flow, and I've kind of alluded to this a little bit, but it's used by managers within the organization. The managers evaluate past operations. They're going to look at what's happened over the last month or year and see how are we manage our cash. And then for planning for future investing and financing activities. So again, we have money that when we have cash, and cash in business, by the way, is too much cash is not a good thing for a business. Obviously, you need cash for operations, and sometimes you like to have a little bit of cash for what we might call like rainy day or something like that. But cash is an asset, and if cash is in the bank and it's just sitting there, it's not being used, all you're getting is a little bit of interest that the bank is paying you. In a business, you want your cash to be buying assets that's going to contribute to more profit, more return on your assets than just money sitting in the bank earning interest, right? So, and you'll encounter a lot of this in your finance class, because finance course is really designed about managing cash, investing cash, and how to use it. But basically, this is just an introduction. So that's how managers, they're going to plan for the future. It's also used by external people. Because if I'm trying to evaluate a company that I might want to invest in, I'm going to pull their financial statements and I'm going to look at their statement of cash flow. And I'm going to say, is their cash going up? Is it going down? If it goes way down, what happened? A lot of times big giant corporations are sitting on piles of cash because they're not really in an investment mode or a growth mode with requires cash. And they're sitting on it. And why do they sit on it? Well, sometimes they purchase another business. And we hear about that all the time, where one company's bought out another company, or maybe they bought out a brand. Procter & Gamble paid $300 million, I think, for the Old Spice brand. And, I think that Google is sitting on, I forgot how many hundreds of millions, if not billions of dollars in cash right now, that allows them to they don't want that cash sitting there. They really want to take that cash and purchase another company or something of that nature. So as an external investor, I'm looking at those kinds of things. If I see that, oh my gosh, their cash just crashed from last year, and then I say, oh, well, they had a major acquisition that they paid cash. How about creditors? Obviously, you borrow money from a creditor, a bank, or any other kind of financial instrument like bonds that you might issue. Those people are going to want to know that you have cash to be able to pay them, so that's external. How about also it says here pay dividends. If I'm an investor and I'm investing in the company, a lot of investors are what they call dividend investors, and they're looking for companies that have cash to be able to pay dividends, and that may or may not be why I'm investing in them. Okay, so let's move on. So one of the things that we need to understand that on the cash statement, and you can look at one from any company. You can go on Google, or Yahoo Finance is a good one. Now you can get into more complicated ones if you're more sophisticated, like Morningstar and some of these others that file more robust financial statements on companies. You also can look at a company's 10K report, and in it we should have their statement of cash flows. But within that statement, the way it's laid out with three types of cash flow activities. So three ways, so to speak, that cash goes in and comes out, inflow and outflow. Three different methods of cash flow, inflow and outflow within a company that's reported on the statement of cash flows. So the first one is operating activities. So we've kind of just talked about that a minute ago. Operating activities are the cash flow from transaction that affects the net income of the company. But operating means I'm out there earning money. It's cash that I'm receiving for providing goods and services, right? You also might be, cash might be outgo because of operating activities, because I'm buying merchandise to resell, or I'm purchasing different supplies and things that I need to keep my company operating. Now, we're not talking about buying a long-term asset here necessarily. We're talking about things that I'm going to spend money on in a given year. That's operating activities, okay? So the next one that we're going to look at is the cash flow from investing activities. Okay, so statement of cash flow from investing activities are from transactions that affect the investment in non-current assets of the company. So if I am a company and I do purchase a building, let's say I'm renting a big warehouse somewhere, and I have the opportunity to buy a warehouse, and that warehouse, of course, I plan on using it for many, many years. So you can see, under this case, I'm investing in that building. I'm investing in that warehouse. It says here, purchase of fixed assets such as equipment and buildings. I might have a piece of equipment that I'm going to buy, and I'm going to buy it with cash, and it's going to last me for a long time. I'm replacing a vehicle or a piece of equipment. So these are things I'm investing in. They're different from operating. So think about operating in the fact that if I have a piece of equipment and I have to maintain that equipment, in other words, let's say I have to, if it's a vehicle, I have to change the oil and the windshield wiper blades and the battery or something like that. Those are operating activities that I'm expending. But that truck, the purchase of that vehicle, is an investment, because that truck is what I'm using to generate money in my operations, but I've invested in that asset. Okay, now I'm going to give you, when we finish this, I'm going to give you kind of a scenario to see how this all kind of works. So the last one is cash flow from financing activities. And now this is money that I'm either borrowing or I'm paying back. So issuing or retiring equity and debt securities. But in general, what we think of here, if I go to the bank and I say, hey, I need $100,000 to buy this piece of equipment, the bank is going to give me the $100,000 to buy the equipment. They're going to charge me interest, but they're going to expect me to pay back their the $100,000 that I borrowed. So the money going back to the bank in principal, which is that initial investment, $100,000, is a financing activity. I received $100,000 to be used in my business, and I have to pay that back. Okay, so now let me kind of tie all this stuff together here, for example. So let's just say I'm going to buy that truck for my business. I'm going to buy a big dually diesel long bed pickup crew cab, very expensive truck nowadays, and I'm going to go out and buy it for my business, and I'm going to use that truck to maybe pull a trailer that's going to have lawn equipment. Let's say I'm a landscaper and I have a zero-turn lawnmower and a bunch of stuff that I use in my landscaping business, and I'm pulling a trailer with this big truck. Now, how do I go buy the truck? Well, first of all, you go to the dealer that sells trucks and you say, I want to buy a truck. And they say, well, you're either going to have cash or you're going to have to borrow money. So I said, well, I'm not going to borrow from the dealer. I'm going to go to my credit union that I use because I get a better rate there and I do a lot of my business there. So you go to the credit union and you get the money. That's the financing. So let's just say the truck costs, let's say $50,000 for easy. Now maybe those trucks cost more than that. I got a deal, right? So they cost more than $50,000 nowadays for a truck like that. But maybe it's used. So I went to the credit union and I borrowed the money. I borrowed $50,000. And I take that, and the bank gives me $50,000 in cash, even though I don't actually physically get the money. They send the money to the truck dealer, right? But the financing part of it is with the credit union. They gave me $50,000 in cash, and I'm going to have to pay interest on that. But the interest is not financing. The amount that I financed was $50,000. Okay. So now I take that $50,000 and I go over to the truck dealer, and I'm just walking through. Of course, this is all automated, of course. But now I go to the truck dealer and I say, I want to buy that truck, and I give them the $50,000, or the bank gives them the credit union gives them the $50,000, but the $50,000 now, and they give me a truck, and the truck is an investment. So here I got $50,000 for financing. I got a truck worth $50,000 and I gave that $50,000 away. That was cash out. So cash comes in through financing, cash goes out from investing, and I have a truck. And I take that truck and I go out and I pull my landscaping equipment and I earn money. And the money that comes in from driving that truck around with all the equipment is operating cash. Now, the other caveat there is, remember the bank, the credit union, bank, whatever you want to call it, I owe them interest. So the interest that I pay on that loan, that $50,000, let's just say it's, well, I don't know what it is right now. Let's just say it's 5% interest. I'm paying 5% interest to the bank for every year that I still owe them some money. Now, maybe I'm going to pay that $50,000 back over a period of 5 years, which, might be $10,000 a year for a principal, but the interest I'm paying every year, I'm paying a portion of the interest, and the interest is operating. It's an operating expense. So it's operating cash, not financing. The financing cash is the $50,000 that they expect to get back. The 10% or the 5% that they expect to get back is operating cash. So in this transaction on this one asset, I got $50,000 from the credit union. I gave away, and it came in inflow. I gave it outflow to the truck dealer, and I got the truck as an investment. And then I took the truck out and I used it to earn money, and I got money back in. But I also had to pay the interest back for that money that was coming in, and those are operating. So that's kind of how, that's a kind of a little scenario so you could see how this whole thing fits together. All right, so now the next thing we want to talk about, well, cash flow, of course, cash flow is sources of cash, and cash flow out is uses of cash. And now here's a little diagram, and you can see here's some of the other examples that they're going to show you. You have operating, of course, the sale of products. This is if I was like a retail and I'm selling. But I also had to purchase those products. So cash outflow might be purchasing those inventories. And of course, I have to pay taxes. I have to pay employees. Those are all operating. If I had to pay, one of the things that they don't have here is that interest that I have to pay to the bank. That's a outflow interest expense, is a cash outflow for operating. I also I provide services, and I get that. Now here we have kind of like what we said, investing. I got cash coming in. Now I might be selling these. Another thing I might say is at the end of the, say I kept that truck for 5 years and I want to turn around and sell it. If I sell that asset, I get the money. See, the sale of property, plant, or equipment, I sell that truck at the end of the 5 years, and because I want to go get another one. Whatever I get for that truck, now that's cash coming in from investing. So cash going out to purchase the truck, cash coming in when I go ahead and sell that. Now I'm talking about the truck, but it could be anything. It could be the machinery, it could be the building, whatever I've invested in. Okay, same way with financing. The financing obviously coming in is the money that I get from the bank, which is long-term liability, or maybe I've issued stock, which I have to pay dividends on. And here you'll see financing, pay dividends to shareholders, which is really my cost of issuing stock, and so to speak, and to purchase common stock, but also to repay the long-term liabilities. This is that $50,000 on that truck that I'd have to buy, okay? All right, so there's two different ways that companies can use for reporting cash flow from operations on the statement of cash flow. Now, this can get detailed when you're actually doing the accounting part of it, and I'm not really going to do that in this class, this video. That will be more detailed later, but you'll see here, I want to talk about, there's the indirect method and direct method. So this is basically, how do we create the statement of cash flow? If I'm the accountant and I'm creating the statement of cash flow, which way do I use? There's two different methods. Now there's the direct method and there's the indirect method. And really what I want to say about this is, on the direct method, it reports the cash flows and receipts on just about, you know, everything that's going to happen kind of as it's happening. Cash received from customers, cash outflows, payments, taxes, expenses, on it goes. And the thing about that is, the direct method is costly to prepare, and as a result is used infrequently. Now, the thing that I encounter when you're teaching these classes is, the books have been around a long time, and although they update every year or every 2 years, they update, but they put things in there like, well, this is how it could be done. And when you read the small print, maybe it's in your book, maybe it's not, the small print says nobody hardly ever uses this, right? Now this says it's more costly and is infrequently used because it's more costly. But the truth is if you're going to follow generally accepted accounting principles, GAAP, they require the indirect method, which means that very few people use the direct method. And I always wonder, as an instructor and even as a student, why do we have to learn this if there's such a small percentage of people that actually would use this? In fact, I wouldn't even know how to tell you if there is anybody that's using the direct method. So that's just a disclaimer that, you know, you're probably not going to encounter this direct method, although your book, your accounting books, typically always walk you through it and actually have you do this method to be exposed to it. Now, like I said, GAAP requires the indirect method. And the way the indirect method is it actually takes your operating activities on your income statement. You'll say beginning with net income and adjusting it for revenues and expenses that do not involve the receipt of cash or payment of cash. So they have to take your income statement, and you're going to reconcile the income statement to cash flow from operating by going through different line items and adjusting them. And primarily what you're going to see is your accounts receivable. You'll see down here it says accounts receivable or accounts payable are your primary places you're going to start, because again, I explained a little bit earlier that you provide a service or provide goods to a customer and they don't pay you, then that's accounts receivable. And your accounts receivable will change from one year to the next. And so if your accounts receivable goes down, meaning less people owe you money, that means some people paid you cash, right? If your accounts payable, for example, I've got some supplies from a person that I get supplies from, and they're going to bill me, and I'm going to pay them next month. And my accounts payable account changes from year to year, and I'm going to look at what it was last year and what it is now, and I'm going to say if my accounts payable, so payable goes down, then that means I've used cash, right? I've used cash because I'm using cash to pay off my vendors that supply me. If my accounts receivable goes down, that's money that somebody owed me, and so my cash goes up. And so those are changes from one period to the next. Remember, originally it said for a period of time. If the cash flow changes, in other words, if your accounts receivable changes from one period to the next period, then cash either went up or went down. If it goes up, if accounts receivable goes up, that means more people owe me which means I have less cash. If it goes down, accounts receivable goes down, more people paid me, I have more cash. Just the flip side for the accounts payable. If I have more accounts payable, that means I have more cash because I've received things that I haven't paid for. If a vendor said I've paid them, I paid them cash, my accounts payable has gone down. So those are the two primary ones that we're going to talk about. Now the other one, and I want to make sure I don't know if I have a slide on it. Okay, we're going to go back here. This is for investing activities. Show the cash flow in outflow related to change of company's long-term assets. So, but let's go back. So there's other things that you might see, like in a depreciation expense on my indirect method, my operating. So on my income statement, I depreciate. I kind of explained this earlier, but you depreciate something on your income statement, which is an expense that shows that you have less profit because you expensed something, but you didn't write cash check to it. So that's another line item from your income statement that you have to reconcile to the statement of cash flows. And again, most of your accounting books are going to walk you through all of this process. I'm just trying to explain kind of how all this works, so to help you understand, because sometimes you can read it and read it and read it. Now, I will say the cash flow statement is one of the more difficult financial statements to understand, and that's why I said I have a theory that a lot of small business owners who's never taken an accounting course don't really understand it like they really need to. Okay, investing, we're going to reconcile that. Cash inflows from investing normally arise from selling fixed assets. So in other words, again, did your assets go up or did your assets go down, right? And then if so, then that means that you used cash, right? Or the opposite. Payments to purchase fixed assets, right? Okay. So these are just other items. Financing, now this is going to talk about changes in long-term liabilities. That means if I've paid off that debt, if I paid that $50,000, my cash has gone down, right? Now this is not, remember, this is financing different from the interest that you pay on your operations, okay? So these are different accounts. Issuing bonds, notes payable, stock. If I issue bonds or borrow money, basically, I'm going to receive cash. That means my cash is going to go up. So these are kind of things that you don't see on other financial statements. So it's not going to be on the income statement. If I go to the bank and I borrow money and they say, here's a check, well, I might deposit it in my bank account so I can use it to go and buy assets or pay operating expenses even. But where do I record that? So on my statement of cash flows, where you're going to see that. You're going to see that cash inflow from financing activities. Okay. And then, of course, going back out. So that kind of concludes the main things you need to really know. Now, again, your accounting book is going to go through all of these different methods of doing this, and it is a little bit confusing, but you'll see that those are really the main things you need to know. Cash flow in and out, operating, investing, and financing, and then the direct method and the indirect method. But the indirect method is primarily what you're going to need to know. No doubt your homework assignment is going to make you do that. And so there you go. I hope this has been beneficial to you, and I appreciate you watching the video, and we'll see you next time. Thanks.